Hi, I'm James Robinson, and this is my third video on the company, The Children's Place. Today we're going to talk about dividends, and also going to talk about debt because the company doesn't really have any debt, so it'll be a pretty quick section. So briefly, and not to get too far off topic, here's a map of the world. I asked in the last video for people to let me know where they were watching me from. It's kind of cool to be sitting in my desk in Phoenix and working on this stuff, and to know that people all over the world are watching it. And if they're getting value from it, so much the better. So people have responded to me. They told me that they're in Miami, they're in the United Arab Emirates, they're in Rome, and they're in St. Petersburg. That's really cool. And if you're out there watching, please just in the comments write where you're watching, and I'll add dots to the map, and it's part of the fun of doing this for me. So I'd appreciate it if you take your time and do that. Thank you very much. Okay, so back to the subject. So first, let's look at dividends and dividends per share. When you look at the company's dividends, you see that they didn't pay any dividends at all until 2013. However, since then, they've raised their dividends every year for 5 years running, and they've raised them pretty significantly, from just over $10 million of total dividends paid to just over $30 million. So that's a tripling of the dividends over that period of time. That's pretty spectacular. However, even more impressive is the amount of dividends per share being paid. That's gone from 50 cents per share to just about $2 per share. Now, the reason that that's quadrupled is because during that period of time, the company's bought back so many shares, and the result is dividends have gone up and the dividends per share have gone up even faster, which again is one of the benefits of buying back shares. Of course, just looking at what's happened in terms of dividend payout doesn't tell us the whole story. So we do always dig a lot deeper into dividends. So again, the four things we look at is what is the yield and what is the growth. Yield is the amount of effectively return on investment that you get as a shareholder if you bought the stock today. Growth is the amount that yield is going up year over year. We look at dividend safety in the context of earnings. So what percentage of the earnings that the company is making are they paying in dividends, and what do they have left for other things? Dividend safety in the context of cash flow. Cash flow is oftentimes believed to be a better measure of safety than earnings are. And finally, dividend safety in the context of the current debt load. Again, that's going to not be very much because there is no debt load to talk about. Here you can see the yield and growth. Dividend yield was 3.52%. That's very good. The average yield for the S&P 500 is about 1.92%. So it's 150%, almost 200% of what the average yield for the S&P 500 is. More importantly, more impressively, the dividend growth over the last 5 years has been 52.6%. So that's a fantastic amount of growth. You can see that a lot of that came in 2017 when they grew their dividend by almost 100%. But even if you look at the other years, in 2015 it went up about 12%, it went up about 25% in 2016 and 2018. So these are fantastic returns, fantastic increases in dividends. And if that trend were to continue, you'd love to own this stock, especially as a retirement stock. So oftentimes I'll tell you that a stock is a stock you should buy because you may be a dividend player and this is one you should own. Or I'll tell you not to do that if I think that the dividend may be unsafe. I think you're going to see this stock is very, very safe, very, very conservative in the way it pays dividend, and those dividends are going up. So long story short, this is a great stock to own as a dividend investor. So yet another measure of how strong the Children's Place is in terms of a stock is the dividend safety in the context of earnings. So what we're really looking at here is a company makes a certain amount of profits, and then with those profits, they pay dividends. If the dividends are too high a percentage of those profits, then when something goes bump in the night, as it inevitably will, and some bad catastrophic happens to the business, they might have to reduce the dividend. And nothing is worse for stockholders in terms of stock price than companies that start cutting the dividend. It really has a catastrophic effect on the value of your stock. So you like a company to have a margin of safety. The average payout ratio for S&P 500 company is around 40%. So they're taking 40% of their profits and paying dividends with it. This company last year paid 32.7%. So it was more conservative than the average company, even though it's paying twice the dividends of the average company. Their average payout ratio over the last 5 years has been 25.3%. So again, they're even more conservative over the last 5 years than they were last year. So long story short, this is a company which is very, very conservative in terms of the way they're paying dividends, and those dividends are excellent, and the dividends are going up at a fantastic rate. So long story short, all looks really good on the dividend front for this company. So in looking at dividend safety in the context of cash flow, I think we need a little explanation here. In 2018, the company had $139.91 million of cash flow from operations. They had capital expenditures that year of $71 million. That left their free cash flow of $68 million. That's money they could use to do whatever they wanted. Of that, they used $33 million to pay dividend. So effectively, 48% of their free cash flow is used to pay dividends. It's a very safe number. Anything under 50% is a safe number. In the past, those numbers have been better, but they've gyrated. There's going to be times where you have more and less cash flow. You look for a trend to be positive. And there's going to be times when you have higher and lower capital expenditures, but you look for the trend to be reasonable and predictable. So long story short, this company, in terms of dividend payout from free cash flow, this year paid 48% of their free cash flow in dividends. That's below the 50% that we consider very, very conservative. And their average payout ratio for the last 5 years is 20.9%. So again, that's a number that we think to be very, very stable. So again, we've talked about this, but dividend safety in the context of earnings is great. Dividend safety in the context of free cash flow is great. The yield is wonderful, and the growth is spectacular. So we know that that those are all strong. And then the next slide, which is dividend safety in the context of the debt load, is going to be fantastic because the company has no debt. So effectively, 48% of their dividends are going to be paid out in. Let me start over. In terms of the corporate debt, no matter what happens to interest rates, no matter how high those interest rates go, it's not going to affect our company's ability to pay dividends because they have no debt that they're paying interest on. So this company, the safety for this company in terms of dividends is wonderful. The amount of dividends is wonderful. So without hesitation, I can say if you're a dividend investor, this is a stock you should be buying. And on top of that, I think the company's undervalued, and you should get some stock appreciation as well. So this is one of those companies that I can very strongly recommend. I'm also going to talk very quickly about debt for this company. There is no debt, so we're going to go very quickly through it. I just want you to know that I've done the research and I've thought about it and give you a chance to compare and contrast on your own. So the first slide, interest expense, you can see the interest expense has gone up very, very minimally since 2013, but it's gone up from less than $1 million to $3 million. The interest expense number, you see that going up, that normally would be worrisome, but you need to keep it in context in terms of scale. So we also look at interest expense as it relates to operating income. And this company's interest expense as relates to operating income is lower than it was in 2008 and is basically been flatlined for a long time. Now you may say, why is there interest expense if there's no debt? Well, there's no long-term debt, and there might be short-term debt. The example I always use is a company may be using a corporate credit card for accounts, and they may be paying some interest on that corporate credit card. Even though they pay that money off, every month or every quarter, there's some amount of debt that the company may be utilizing for short-term, and they're paying some interest on it. But it's a de minimis amount. It's not important. And less than, in this case, 4% of their operating income is used to pay debt. Effectively, that's no debt. Here you can see the debt analysis. The blue is total current liabilities. You can see since 2011 that's gone up pretty significantly. However, it dropped in 2017 marginally. The company made a lot more money since 2011. And we've always talked about this with every slide, but when a company's income is increasing, especially a retailer, that typically means that they have more stores, more employees, more inventory, and all of those things add up to total current liabilities. Again, just to make sure you're familiar, a current liability is money that you owe somebody within the next 12 months. So nothing really to look at here. This is sort of exactly what you would expect if you've watched companies that I like to invest in. The next thing that I like to do is look at the long-term debt related to the company's earnings. The analysis that I use is how many years income would it take to pay off the long-term debt. There's no long-term debt, and therefore it takes no time to pay it off. Interest coverage ratio is how much total income that you have and how that income is related to interest expense. So how many times, if you have $1 million of income and you have $100,000 of interest expense, you would have an interest coverage ratio of 10, right? So you'd have 10 times as much money as you need to pay your interest. So this company is in the neighborhood of 35 or 40 times the interest that they need, the income they need to pay their interest. The interest is de minimis, the income is stable. There's just no reason to be afraid of the interest coverage ratio. This is a very, very solid interest coverage ratio, clearly in the top 10% of companies. This is a chart that would be worrisome if I didn't understand what was going on here. So this is cash and marketable securities. So cash is obvious, that's how much cash you have on hand. Marketable securities is money that you could sell within the next 12 months and liquidate for cash. Now, if you see here, the company's had a massive drop off from about 275 million to 75 million in cash and marketable securities. That is, to a large function, a factor of the fact that they bought the Gymboree brand. They paid $75 million for the Gymboree brand, which I think is going to be accretive to earnings. I think that's going to be a good thing over time, and I expect this number, cash and marketable securities, will start to pile back up again as the company begins to operate and run this Gymboree brand. But through the process of the Gymboree brand, they had to buy the brand, and then they've had to invest monies in getting it ready to go. And so that's cost money and takes money to make money. Now, we just described how there's a reduction in cash and marketable securities. That should cause concern as it relates to current liabilities. So current assets is how much money we have either currently or we could get turned into cash in the next 12 months, or money we expect to receive in the next 12 months. Current liabilities and capital leases is money we know we have to pay in the next 12 months. We like to see a buffer between those two, and here you can see there is a buffer. And you can see that even though there was that very significant drop-off this year because of the Gymboree acquisition, we still have a reasonably safe margin in terms of our current assets to current liabilities, which is why, even though I see that gigantic drop-off this year in cash and marketable securities, I'm not concerned, because in the context of the business, I don't really think it's a problem. So in summation, what I hope we've learned from this video is the company pays a solid dividend, about 175% of what the typical company, the S&P 500, pays, that dividend is growing at a very good rate, that they're not paying too large a dividend relative to their earnings, they're not paying too large a dividend relative to their debt, to their cash flow, that debt is not going to be an issue in their ability to pay earnings, that they have no debt or very little debt, that the interest payment is insignificant relative to the operations, that they have current assets far in excess of where they need to pay current liabilities. Long story short, this is an excellent company, both from a debt and from a dividend perspective.